How would you like to make your first million? And today we have Brian, which is the founder of the Texas Freedom Fund, but also he's a real estate investor. So, Brian, tell us what are the 5 steps that you recommend entrepreneurs in order to make the first million?
Welcome to Unstoppable Podcast with Harry Sardinas, inspiring conversations with influential millionaires, investors, thought leaders, entrepreneurs who are making a massive difference with their innovative products and services, and sharing the challenges and wisdom of how they sold their first million.
Well, I'm sure. Thanks for having me on the show, by the way, to start off. But I'm sure everybody's kind of got their own unique formula. But all I can say is what's worked for me. So you got to start out with your customers. So for what we're doing right now, our customers are our investors. So go out and have lots of conversations with people. I like to vet the idea and really vet it all the way before we go operationalize anything. So I think I probably talked on the order of 100 investors before we put our fund together, just to make sure some of what we were thinking about was going to worked well, and get all that feedback and really be able to weave that into the early conversations. So that was step one. Step two after that for us was check out our unit economics. So we needed to make sure we could cover our costs for all of the administrative overhead, all of the attorney's fees, make sure we understood how all that was going to work, and be able to weave all that into our fee structure before we actually roll things out. And then the third step after that for us was to model the assumptions. So, what is this thing going to look like at scale? It's great that it works well on a unit basis, but then once you start to apply scale to it, what does the model look like after that? And then after that, we went out and talked to a bunch of experts in the industry for the last 6 months, or like actually the first 6 months of this venture. We probably talked to about 15 securities attorneys and about 20 accounting firms and a bunch of funds administration firms too, just to figure out what the market looked like and to figure out who was going to be the very best set of partners for us. And the team that you put together to be able to execute is a really important part of any new venture. And then after that, the fifth step I wrote down is avoid unnecessary expenses and order your priorities ruthlessly and then iterate. So anything that you're starting that's new by definition has probably either not been done before or it's not been done before by you with the specific way that you're doing it. And I like to call that dumb tax. So you can pay a lot of dumb tax if you don't order things the right way. And there's always going to be lots of people who show up to sell you things in your journey along the way. And you got to really be very ruthless in what you're trying to spend money on, because you don't have a lot of resources when you first start things. In fact, I think that's part of what gets a lot of entrepreneurs into trouble, is that they end up spending money on all these vanity things, websites and stuff that you're going to need in the long run, but maybe that isn't the optimal way to use your time and your resources when you're first getting started. So you really need to be very lean with your approach.
Talking to your customers, something that is key, Brian. I love that you brought this up because exactly what you do, what we see a lot in entrepreneurs, they want to have a business and they worry about the logo. They're paying a lot of money with the logo. They're paying a lot of money with the website. They're investing a lot of things and allocating time and resources to speak with the client to see if the product that they want to create um, uh, the market wanted and how much they want to pay for it, and did they actually happy with the product or they want an improvement. This is something that startup founders and people from going to 0 to 1 million, um, they get lost in translation, right? And then they give the importance to the clients, and especially in this part 0 to 1 million in the very beginning, it's all about speaking with the client. It's all about getting feedback, right? So I'm glad that you brought this, and I think is important. However, Brian, for you to be from a real estate investor, a successful real estate investors, to move into, I got a degree in chemical engineering, and you with me a little bit more about an oil and gas fund and cracking and all this. It sounds complex. Why? Compared with property, that is something that everybody understands. You buy a property, you rent it, or you do a commercial, you get rent, and this is something that everybody can understand. And you were doing amazing doing this. So what led you to make that change, to make that pivot to something which is a bigger game, bigger numbers? And I got a degree in chemical engineering. I can tell you that it sounds complex to me.
Well, it is complex, but I think the more complicated part, at least for me, of what we're doing is done by our operators. They're the ones out in the field, they're the one with the expertise. For me, I'm a deal person. I'm a deal junkie. And so I've been doing real estate projects for 20 years, and there's really not that much difference. And they call things different things. There's different accounting methods. But at a deal level, standpoint, the investors care about the same sorts of things, right? They care about the returns. They care about the tax benefits. They care about how long their investment's going to be tied up. They care about the waterfall structure. What everybody's looking for with a great deal is a CD with a lottery ticket tied to it. So, we've actually tried to structure our offering like that. One of the things I've learned in the deal business for the last 20 years too is that a confused mind says no. So we've really very much tried to make the deal as simple as possible. It's just a simple split. That's it. If you start talking to, retail accredited investor types or people that are, normal folks, they're smart folks, but you start talking to them about hurdles and clawbacks and this crazy structure, and people's eyes roll over and they just, they decide to go do something else. So we really have purposefully tried to keep the deal structure as clean and easy as possible. And that to me is part of our value proposition. Most of these deals that are put together, people have to invest on the order of $250,000 to get into them. And we very purposefully have structured ours to with the minimum investment size is $25,000. So, that's all part of just things that I've learned along the way. There's really the same sorts of things that people care about for these deals that they care about in real estate deals. It's just a different industry.
100% agree with you. At the end of the day, real estate investor, as an investor and sophisticated investor, what is important for you is what is going to be the return, how much is going to be, and what the risk involved. And then the vehicle,
Right.
sometimes we is to a second nature because this is what the investor actually evaluate. And if they coming for real estate, they will compare to real estate investment, right? So what are the risks involved comparing to real estate? Again, real estate, we all know the risks. If you buy a house and you cannot rent it, well, yeah, you have to pay the mortgage and
Right.
you have that risk. So you have to make sure that it's in a place that can be rented. And we talk about cash flow. I'm a big fan of cash flow, and the property business that we had to sell 5 million was purely cash flow, rent to rent, good in cash flow. And the thing that I see a lot of in the investment out there is, okay, you invest in this stock, we invest in this, and your capital is gonna grow a lot. So everybody talks about capital growth. Nobody really
Right.
talking about cash flow, which is for me this is way more natural that investors can get the return on the money because we have to pay bills every month. We have to buy food every month. So if we can have a
Right.
monthly cash flow or quarterly cash flow. So how is that different, Brian, and tax and the risk? If you can share the difference.
Yeah. Yeah, I mean, there's certainly a lot of risks in both deal types. So I guess we should start there. It's for accredited investors for a reason. I've done lots of real estate deals in regular markets and great markets, and then is a genius when the market's going up. I've also done deals when the market has crashed, like it has recently. So I've seen kind of both sides of that. A lot of folks that are newer in their career haven't really been through all of the different cycles, so they don't really even realize the risk that they're taking on or how to structure deals properly because they haven't been through the various cycles. Um, Real estate, I think it depends on what you're doing. My sort of expertise was ground up development projects, urban infill projects in the Austin area. So I knew that market really well, having grown up here. Being able to identify undervalued opportunities and design in safety margins helps. But really, nothing helps if the Fed decides to raise interest rates 11 straight times, and all of the interest rates for an average consumer double or more, right? That's going to impact the price of things. For those types of projects, there's lots of risks. There's slip and fall risks, there's contractor risks, there's timeline risks. But really, the biggest risk is just the market. You're bringing something to market that's maybe 18 months out or 2 years out, and you have no idea what's going to have happened by then. You don't know if we're going to have bombed another country, or if we're going to have a big tariff war, or there's going to be floods like there have been in Austin recently. So there's lots of things that you just really can't control. There's certainly risks in the oil and gas space too. I really think the biggest risk is the price of energy. So there's a lot of interest in the world that really want to try and keep oil prices between $60 and $90 a barrel. If they tend to get too much higher than that, economies go into recession. If they go too much lower than that, a lot of some new supply tends to come on. So that sort of like sweet spot right there is where things are. But there's times like COVID where everything goes to like $20 and $30 a barrel. And so that's really, it's a very volatile business in terms of that. But one of the things I like about it is, like it or not, petroleum is still like one of the main inputs for our whole energy ecosystem worldwide. I know that there's all of this green energy movement and things like that, but for better or worse, we're still using more energy right now. And a lot of that's driven by growing middle class and like China and India and places like that. A lot of that is also going to be driven by the AI revolution. So there's very smart money companies like Microsoft that are purposefully building all of their data centers next to like 3 Mile Island and kind of hooking into that infrastructure. And they're doing that for a reason, because they're looking out, 5 years on the horizon, and they're like, this is going to be our bottleneck and our big constraint. So we're very bullish on, the market for energy, just because, a lot of that energy consumption is going to be competing with, the basic needs of folks too. And for better or worse, energy is the energy that comes from petroleum is still really what's driving our world, and it probably will for some time now. So that's really the biggest risk for these deals. There's other risks too, a lot of which you're relying on somebody like the sponsor, for like me, to design as much as possible. What's the operator's track record? How are they indemnifying investors? What kind of protections are you setting up legally? Let's make sure that we vet everything for the right way, so we've got all of our tax advantages in track. So there's lots of things we could talk about, but they're similar deal types though. You mentioned flow. The way our deals were structured, we get each month the same way somebody would with a real estate project, which is nice steady income. You don't have to wait for some appreciation event. So you're able to see pretty much real time what the market's delivering month to month. And really all of that is mostly a function of the price of the oil at the time.
And at the end of the day, Brian, with all the increase of AI and even the cars, what has happened in the world in general is more demand from energy. The demand for energy has increased huge, to the point that some undeveloped countries, they cannot meet with the demand anymore. They don't have enough energy source, because the truth is, because we have more electric cars, because we have more servers with AI consuming energy all over the world and so on. It has the demand of the huge, and we need to face it that it's a daily use thing. Everybody wake up in the morning, and if you don't have gas, you need to go to the gas station. And this is something that people use every day. I wish share with the good sign is try to invest in something that people use every day because it's daily use. It's more likely that it's not going to go to zero overnight, right? Because we all
Right.
are using it for a reason, and there's the demand, and on top of that, the demand is growing, and yeah, it can be a lot of advance in the and a lot of advanced technologically, but I do have a degree in chemical engineering, so the amount of derivatives and hundreds of products that comes from petroleum that they are key for society,
Right.
So this is not going away. In fact, United States have done one of the best strategies ever that I have seen in my case. For so many years, they hold the reserve, and they have been buying it from other countries,
Right.
and which is we demonstrate the vision, right? That this is a resource that is also the fluctuation that I spoke about. Yeah, because if the price goes down too much, it's too expensive to get it out. So he has
Right.
to keep it. Here is a big point in the United States to win the election, the price of gasoline. Yeah, yeah. If you are the best politician ever in this planet, but your your gasoline price
Right.
goes up, and you U.S. politician, you are in trouble because this is the mention economy. It's a good sense of the economy. At the end of the day, if you have gas prices really high, it affects everybody that drives the car, and this is something that is a daily use. United States, where I live now in London now, right? Well, in London also, they drive car everywhere. It's not different.
Yeah. Well, one of the metaphors I like to try and use too is like when there was the gold rush, everybody that made all the money was selling the shovels, right? Or they get the gold out of the ground. And there's going to be tons of value in terms of disruption from AI in the many years. In fact, I'm seeing it a lot with what we're doing with like flows and marketing stuff, and all this agentic AI is getting set up, and it can do what a lot of humans used to do very slowly, really quickly now. It's actually kind of scary the pace that it's happening at. But at the end of the day, all of that's going to require energy too. And I think that's going to become more and more a part of people's lives. And that's really our big bet here is that the price of the energy is going to continue going up for better or worse. I also think that depending on how you're doing what you're talking about, the politicians are not going to stop printing money either. So we've got fiat-based currency that's going to continue to happen. And so we're a big believer in just real assets in general. Real estate, that's what I've done for 20 years. You have a real asset, you've got debt on it. If the government inflates away the money, they're also taking away your debt, right? If you're renting it out. So some of the same principles apply here, right? If the government's inflating away the money supply, or what the purchasing power of your dollars, something that everybody needs, energy, is going to tend to do pretty well in that environment. We're also big believers in Bitcoin and things like that too, but that's maybe a little bit off topic for what we're talking about here.
Oh yeah, yeah. Okay, I'm glad I brought this up. You see, because this Bitcoin, my team already the other day brought this to my attention. Harry, look at the price of Bitcoin is going up. Wow, that's amazing. And I'm sharing with them. I said, look, this thing can go to zero overnight, to zero. That's my opinion, right? Because it doesn't. I don't so much tangible valuable compare with other things, right? And what you have on other cryptocurrencies out there that they have been go to zero in in
Yeah,
in,
yeah.
in
Bitcoin
24
is
in
fundamentally
24 hours. I mean, it's growing in value. We were discussing, have a huge discussion. So, well, what justifies this value? So, well, everybody who owns believe that it was this thing, right? So at the moment, because everybody that owns this believe that worth that much, that's the value of the thing. But at the moment that people stop to believe that this worth that, this is problem is gonna happen because there's nothing to sustain. I think oil and gas is different because people is not, they don't need to think, or they don't need to get an agreement how much it's worth. If you don't have petrol, you cannot move your car. You cannot go to
well, that's true for sure.
you cannot
Yeah, that's
on your
definitely
mobile
true.
phone. So it
Yeah,
clearly
there's
not
a
very easy to assess, right? And that people want to want to pay, right? So very
Yeah,
few
there's a
people that
proof
go
of
to
work
zero,
component.
right?
Yeah, well, there's a proof of work component built into Bitcoin. So we could have a long conversation about that. But point taken, if you get up and you got to operate a car every day, that's something you're going to need, right? Part of the think about is if the dollar price of, energy is going up, is that really more of a function of the scarcity of the thing, or is it more of the dollars are worth less in purchasing power? How much of each is contributing to sort of like the spot price at any given time? So we could have a long philosophical conversation about that too.
Yeah. So Brian, let's talk about returns as well because talking about real estate, you're a real estate guy. So when something we can call it safe, there is nothing safe when you invest it. Let's get this clear here. In the broadcast, there is always risk attached to it, but we can say low risk, real kind of good project can give you a return between, we can talk about 8%, 10%, 12, something that is not so much risk, and can that is normal. Above like above of these, sounds a little bit out of the ordinary. Maybe the risk involved is higher than what you think, and it hasn't been you effectively, or things like that, right? This is my opinion. So can you make us the returns in terms of risk, meaning what is kind of normal in the real estate, or what is high risk
Right.
compared with in oil, and also about the tax as well. If you can share a little bit more, how much tax you will be
Sure.
paying on those earnings in real estate compared with oil and gas, that would be helpful for our audience.
Yeah. Yeah. No, so that part is really important too. It's not really what you make, it's what you keep. And it's, what is your after tax take, right? So that's something that's it's really important, and that's part of what got us into the space. Real estate deals can be structured with really low returns and low risk, and they can also be structured with really high returns and high risk. It just depends on what part of the capital stack you're investing in and the asset type. So, ground up hotel developments are quite a bit riskier than a stable Manhattan apartment. But they are subject to different types of risk too, right? So one of them is probably, there's projects that are going to be more susceptible to swings in equity values, and there's other ones that are going to be more cash flow based. So it really kind of depends. But I think the range that you gave is probably about right. Maybe 6 to 20%. That's probably a pretty nice range. There are some projects like from select operators that have identified great distressed asset opportunities and things like that. And you can get higher returns in real estate for sure. But a lot of times that takes a lot of capital to be able to do properly too, to be able to act on. And the average investor just doesn't have access to those resources. And they also don't have access to the opportunities because they're busy out trying to make money during the day, doing whatever it is that they do really well, right? The oil and gas deals that we've structured, they generally they're long-term investment opportunities. So nobody should invest thinking they're going to get their capital back in 6 months because we don't really have a liquidity mechanism like that built into how we've set it up. But the deals generally, so they're in the Eagle Ford Shale and South Texas. They generally return capital in about 3 years. That's average. Now, it obviously is subject to all of the things we talked before, the price of oil and things like that. So if it dips, it might be 5 years. It might be some other number of years. But kind of in that sweet spot, it's about a 3-year return. That's without tax benefits. And then after you get your capital back, we usually tell folks it's between like 1 and 2% cash on cash return monthly. But the thing that's great about this is that you are able to deduct almost 100% of what you put in against your active ordinary tax income. And this is for US based investors in year one. So if you put in 100 grand, you get to take that as an active, most of that 100 grand is an active tax deduction in tax year one, which is great for high active income earners, which is what we were. And that's kind of how I got enticed to the deal structure to begin with, or just the space in general to begin with. And then also the first 15 cents on the dollar that the deals make are tax free as well, the way our deals are structured, which is nice. So I like to tell everybody you should not get into the deals chasing the tax benefits, although that's generally what gets people interested to start because most of the people probably that are listening to your podcast, if you look at your overall expenses year to year, your number one expense and the thing that's the most rife for being able to save money is your taxes. I know that that's the case for us. So any way we can move the needle on that is advantageous. So if you do this right, depending on what tax bracket you're in, if you invest in 3 or 4 deals, usually the next deal is basically house money for free because it's money that you would have saved from taxes that you saved that you would have given to the government instead. So we like to think of these as kind of like a laddering strategy, kind of like a bond ladder almost. You invest, you let some of the money come back. You invest in maybe another one the next year, let some of the money come back, and that's you just kind of roll it through tax year to tax year. And over the course of time, it's going to save you a lot of tax. And it's also, once you get all your money back from, the deals delivering the capital back, it's a nice income stream. And I don't even like to call it mailbox money because it's not really coming to your mailbox anymore. It just shows up straight into your account through our funds administrator. So I don't know how many people have played like, the cash flow game by Robert Kiyosaki or something like that. That's really what this is in real life, is being able to be able to do your freedom. And so that's why we've called it the Texas Freedom Fund. It's a pathway to be able to take charge of, break free, design their legacy. And that's what most people are after, generally in life, is autonomy, mastery, and purpose. And this is a vehicle to help them achieve those goals.
And all the deals are based there in United States, in Texas, right? Or you're doing internationally as well?
All of our deals are in Texas, so almost all of them are in the Eagle Ford Shale in Texas. We do have some select projects in the Permian Basin as well, out in kind of the West Texas area.
And Brian, the next question is related. You were talking about the Robert Kiyosaki and how to build wealth, right? And that's why I was some confident. You tell me, Harry, at the end of the day, when you see the parameters are the same, but what lead you to that? What lead you to understand that this is a good vehicle with an amazing return, and you actually pay less tax, so you can keep more money, right? For you to learn and to start to explore this opportunity, right? You have to experience something before, and the before was the real estate. What message or do you recommend to the young people listening to the podcast, and the people that they are already have medium-sized businesses? This is something I discuss a lot, okay? That a lot of start a business, and after when they start to make money, right? You have take this money, then you reinvest in the business. They take this money, they reinvest in the business, and sometimes the business, more than business, especially in a startup, is a huge risk. What I'm sharing
Right.
sometimes with entrepreneurs is, well, if you're making some money, trying to find a good vehicle, could be property, could be oil and gas, that can give you cash flow, can give you return, and then you take this return, you take this cash flow, then you can use it for marketing. Because
Right.
in case that your company goes out of business, in case you have this cash flow, you have this return, you have these other vehicles that can you don't need to start all over again from zero. In terms of the advice you have for entrepreneurs that take all the money that they make, I was one of them all those ones when I did my first business. Every money that I make, I'll put it in, and it was a property business.
Right.
I expand, and more money, and I expand, and let's take the world. And we were about to take the whole world, and Airbnb came, and it was and you have to start to quickly to de-escalate, and the whole thing get de-escalated, and something that we managed to sell 5 million very rapidly becomes really, really tiny. So the whole point in terms of creating wealth, in terms of because we want the entrepreneurs to be healthy, wealthy, and happy. We don't want that
Right.
they work and they also they work, they build the business, and just for lack of knowledge, lack of financial education. A lot of people talking about how to make money. Nobody talks about how to keep it. It's a topic that
Right.
you right in your backyard. Yeah, everyone talking about making it, so it's actually easier to make it than keeping it, because to keep it you need to discussing today. Here you have to become an investor. More than that, a sophisticated investor, which is requires experience, requires a level of understanding. So what advice do you have for entrepreneurs, startup founders, and those ones that are in the journey from 0 to 1 million, in order to get some how we can mitigate the risk growing the business?
Yeah, I mean, risk and diversification, I mean, that's the classic thing that you're talking about, right? Like how much of your winnings are you going to go reinvest in something that you're operating? The challenge is when you're actively operating it, the business in a lot of ways, probably, especially at the stage you're talking about, is highly dependent on you, right? And your how much you work, how much you put in. And those are definitely going to be necessary things when you're getting started. But as you start to realize some winnings, then you have to really make the mindful decision about how much of that do you reinvest in that, and how many chips are you taking off the table, diversifying, and where are you diversifying them, right? And I really like your idea of, cash flow. Equity kind of comes and goes, equity appreciation. A lot of times it's kind of hard to time exactly where it's going to, manifest because it depends on things that are outside your control. For instance, in the real estate space, a lot of it depends on interest rates, right? But if you've got a startup that's trying to sell, it might also depend on, what's the M&A space look like at any given time. Where are interest rates for that sort of business at? What's the economy going to do? Lots of things that are kind of outside of your control. And that's one of the things I love about what we're doing is that the energy business isn't going away. Good, bad, whatever's happening. It's kind of a little bit sinister to think about, but when there's a lot of strife and there's blood in the streets, the energy prices tend to go up, right? Because they're basic input to a lot of different things. So, the advice I have is just make sure that you're being mindful of, kind of where your chips are and how you're placing them as you grow in your journey. And don't fall in love too much with wanting to be on, the success magazines or anything like that. Really try to figure out how what you're doing is very purposeful as part of your overall design for your life. Make sure that you're, taking care of yourself in the process too. Your health is very important. This is one of the things I've had to learn painful lessons about along the way too, is that, it can destroy relationships. It can just, so you really want to make sure that you're mindful of all of those things, because at the end of the day, if you don't have your relationships, you don't have your health, you don't have the other things, who cares? I mean, you're going to be the richest person in the graveyard. I mean, who cares about all those winnings, right? So just really being able to try and design a very purposeful, balanced life. And at the end of the day, that's more long-term sustainable too. If you're passionate about it, that's great, but you also have to be able to pace yourself, because most of anybody that builds something great, it ends up being more of a marathon than a sprint. So that's one of the things that I think that is a very high characteristic trait of entrepreneurs too. The best ones is just grit. In fact, the name of our property development company is Integrity Development, and the grit as part of integrity is highlighted. And I think that that's something that's very much necessary, because you have to be able to control your emotions through the process, because there's going to be highs and there's going to be lows. And you got to make sure that you're okay with both and able to, sort of see your way through both of those, because you're definitely going to get them if you're an entrepreneur. There's going to be lots of curveballs that get thrown at you that you weren't expecting.
The challenge that we have, Brian, is that we have excellent entrepreneurs, right? Good investors, sophisticated investors, they used to be good entrepreneurs, right? But it doesn't work the other way around. Good entrepreneurs not necessarily
Right.
become what we call it the sophisticated investor. These the investors, they don't become overnight. This is another step that have nothing to do with the entrepreneurship, because as an entrepreneur, sometimes you evaluate risk high. You start a new company, nobody care about it, so the risk is huge. And then you create the product and you start to sell it, and that's it. You make a million, amazing. And however, when you then somebody can offer any product with the risks and something very uncertain, and because they operate in that level, and this is the level that works for them, sometimes they allocate that fund and it's completely different book, right? You need to know, and then sad to hear entrepreneurs make a lot of money, they invest somewhere else and thinking that it's gonna work, and just from knowledge, right? Because financial education, they lost a lot of money, and the life work. It happened even in real estate, right? They promise we're gonna do this hotel, we're gonna do this, and then they give away the money, and they haven't done the due diligence effectively, which is a part of being a sophisticated investor and nothing to do with entrepreneurship. So, Brian, somebody's in love with our conversation. How they can find you? Which website they can visit? What resources can you share? And most important,
Yeah.
what message do you have for entrepreneurs? Because the more you practice, the better you become, right? And some people might say, "Oh, it's too good to be true that you invest in this gas and oil project and you're gonna get this return. This sounds too good to be true." Okay. On the other hand, somebody that has some education, someone that have some resources, some entrepreneur that can start the journey parallel. I believe that entrepreneurs should be running parallel, the same way that they growing the business. growing the financial education and become a sophisticated investor. No, only lucky ones that manage to exit the business. They from that point you need they start zero. Lots of them have been in this broadcast, right? Harry, I already exit. I exit 2, 3 times. I have few millions. Don't know what to do. Thinking, I'm talking with financial planners. I'm talking to this, but now they are in this position that from that moment they need to start to learn a new thing and to develop
Right.
skills. Whether if they can do parallel what their business is growing the business, they can diversify along the way around the business.
Right.
Nothing happened. I have different vehicles. So some resources, Brian, and how can you help people?
Yeah, so right now we don't even have a website set up. The fund's so new, but so the best way to contact me is just reach out to me on LinkedIn. I'm Brian Hancock, BryanHancock. Love to chat with anybody that's interested in talking some more about any of the topics or the fund. But resources in general, I think it's what you said. And I think it's challenging for folks that are starting something because it's so all consuming. They really want to put all of their effort into it, and that's what's needed to make for a successful venture. But if that's to the detriment of being able to grow yourself, to be able to go learn how to keep some of what you've made, you're probably over indexed and over invested in that activity, right? So there's very simple things you can do, like with trust deed investing. There's lots of resources online. I have these long-winded, great conversations with Chat GPT now, which and then also with Google Gemini. I think it's just amazing. So you can ask it just some really general questions, and I know that they're coming out with all sorts of new educational features to be able to educate yourself. So it's just amazing the tools that are out there now. I also think for startup founders, Ben Graham has a lot of stuff that you might check out his articles. I'm sorry, it's Dan Graham. Dan Graham on the West, check that out. He's got a lot of great articles for startup folks. That's really less of my world. I've run real estate SaaS startups and like that before. Most of my experience has been with real estate and deal by deal things. So less so in an operating company. So you might want to listen to somebody else's advice about that more than mine. But yeah, I think a lot of it is grit, determination, and making sure that you're educating yourself about how to keep the money net of taxes, and then also net of all the other risks that are uncontrollable. So some of the things that you talked about, talking to financial advisors and things like that, are probably good. A lot of their investment advice is sound, but I also think that they tend to be very Wall Street centric and 60/40 portfolio centric. And I think there's lots of other ways to diversify your portfolio that actually give you better risk adjusted returns. And a lot of those involve real assets. And the reason that they don't sell those things is because they can't make a commission on them. And it's not necessarily what's best for the investor in their portfolio. So I think just having sort of a mindful, like scrutinizing eye going into those conversations and really realize that everybody's selling their own book, right? So people are only going to be as good as the advice they give is only going to be as good as, their ability to benefit from it in most cases. So just make sure that you're just keeping that in the back of your mind whenever you're trying to figure out the best way to allocate your money and your time.
Thank you so much, Brian. And have been a pleasure to have you in the broadcast. And for all of you following the Unstoppable, see you in our next episode, how brave entrepreneurs like Brian break the wall and achieve the million. Bye for now.
Follow us for more interviews with world's most influential, audacious entrepreneurs that overcame challenges and adversity, providing you with the blueprint of how they sold their first million so you can grow your business exponentially.